Hey friends, it's Iggy here and welcome to the Investing Iguana channel. If you're new, I'm your friendly neighborhood guide to all things stocks, finance, CPF, and wealth building right here in Singapore. Our channel just crossed 1 million reads and 58,000 likes, and as of June 2025, we've produced over 900 videos with a whopping 500,000 watch hours. We're also honored to be ranked 8th in the 2024 Influential Tigers by Tiger Brokers. Whether you're CPF maxing or planning your dream HDB, you're in the right space to get ahead. Let's kick off today with a scenario that's probably familiar to many of you. You spot a stock with a tempting dividend yield, and its ex-dividend date is coming up fast. You think, I'll grab at that dividend and make a quick win. But here's the catch. A few months later, the company slashes its payout, and suddenly you're left holding a stock that's lost its shine. This happens all too often, especially in the ever-changing SGX market. Today, we're putting the spotlight on SIA Engineering Company, ticker S59, with its ex-dividend date just around the corner on July 28th, 2025. If you're a dividend hunter or just curious about how to identify truly sustainable income stocks, stay tuned. I'm going to walk you through my 7-step dividend investor playbook, a checklist built to help Singaporean investors like you separate genuine dividend gems from value traps. First, let's get to know SIA Engineering. This isn't just the mechanic of the aviation industry. They're an award-winning servicing giant with over 80 international airline clients and 24 joint ventures across 8 countries. Their roots stretch deep in Changi Airport. And as Singapore's top maintenance, repair, and overhaul provider, SIA is right at the center of Asia's booming air travel recovery. Now let's dive in with step 1, setting the context. SIA has just posted stellar results for the full year 2024 to 2025. Net profit is up 44% to 139.6 million Singapore dollars, with revenues climbing to 1.25 billion. They've proposed a final dividend of 7 cents per share, consistent with their policy of rewarding shareholders, and the upcoming ex-dividend date is July 28th. That's why this deep dive matters today, not next month. Step 2 is about yield. SIA's current dividend yield stands between 2.4 and 2.7% by most reports, while some trackers show a forward yield up to 4.2% due to recent share price dips. Usually, Singapore investors look for yield between 3 and 7% to balance reward and risk. SIA is just below the classic sweet spot. But remember, a sky-high yield often signals danger, while a stable but moderate yield, like SIA, suggests management discipline rather than desperation. Step 3. Time to assess dividend sustainability. The payout ratio is our first check. This year, SIA's payout ratio comes in at 73%. Down from last year's 93%, but still well above our ideal comfort zone of 35 to 55%. This basically means 3 out of every $4 of profit go right back to shareholders as dividends. There's not much slack if earnings take a hit. Next up, the dividend coverage ratio. SIA hovers around 1.3 times, which is below what we call the safety zone of 2 times or more. If company profits drop by even 30%, the dividend would be on shaky ground. Looking at the history though, SIA has paid out dividends for more than a decade, usually twice yearly. The one hiccup, some cuts during the COVID crisis, and a few tough years. Still, that's better consistency than many peers. Let's go deeper in step 4 and talk about cash flow and debt. Cash is king, especially when it comes to dividends. For the past year, SIA's free cash flow almost doubled to about $103 million. That's robust growth and a strong recovery sign. But, and it's a big but, sometimes nearly all of that free cash flow is paid out as dividends. At times, the ratio went as high as 98%, meaning the company had very little cash left over for anything else. Investors need to watch this metric if they like to sleep easy at night. On the bright side, SIA is one of the least leveraged firms in the aviation sector. The debt-to-equity ratio hovers around 0.3%, which puts them way below the levels where debt becomes a risk. Some reports show it could rise to about 5.9% with different accounting treatments. But even that is a non-issue compared to industrial peers. So in terms of debt, SIA gets high marks. Now step 5 is all about earnings stability and business quality. Over the past 5 years, SIA's earnings have swung by about 15% year on year, a little bumpy because of the pandemic, but now on a steady uptrend. This is well below the 20% warning zone, which is good news. Besides, Singapore's aviation sector is in expansion mode, with passenger traffic at Changi almost back to pre-pandemic levels, and more airlines extending contracts instead of retiring older aircraft. What about the moat? SIA's competitive advantages run deep. They have regulatory approvals from 29 global authorities, meaning airlines would face huge regulatory hurdles to switch. Their Changi base puts them in the busiest air corridor in Asia, and their deep ties with both OEM suppliers and strategic partner airlines lock in business for years. Plus, SIA has invested in advanced tech, like its award-winning E-Lite maintenance platform, which not only improves efficiency, but also makes it stickier for clients. High switching costs and established partnerships are true moats in this business. And don't forget the relationships. SIA has locked in long-term component supply agreements with major OEMs, giving them critical priority access to parts during shortages. That's a hidden edge when supply chains get tight, as we've seen in the last couple of years. Now let's pause for a quick reminder. If you want my full written report, all the data, and a downloadable, interactive version of my 7-step dividend checklist, head over to the Investing Iguana Substack. Link in the description. That's where my best deep dive research and analysis live, free for all my subscribers. Step 6 is our risk red flag review. Is SIA's yield above 10% signaling a yield trap? Absolutely not. Today's 2.7% is reasonable. Is their payout ratio screaming alarm bells? At 73%, it's high and worth watching, but not at crisis levels. Is the industry outlook grim? Quite the opposite. The Singapore MRO market is forecast to grow steadily for this decade, with Asia Pacific leading global aviation repair demand. Regulatory risks exist, but Singapore's framework remains stable, and SIA's partnerships provide strong buffers. The only real caution is labor. Singapore faces skilled talent shortages in aviation, and rising wage and supplier costs may keep margins tight. Let's bring it home with Step 7, the final score, and my verdict. On a scale of 1 to 10, I'd rate SIA Engineering a 6.5 out of 10 as a dividend stock. Here's my quick summary. SIA has a solid moat, industry leadership, strong cash flow recovery, and some of the lowest debt in its sector. But dividend coverage is thin, and the payout ratio is on the high side. The history of cuts, though understandable during COVID, means income investors should expect some bumps in the ride. My take is that SIA is not a yield trap, but it isn't the best-in-class safe dividend play either. If your goal is stable, predictable passive income, you might wait for a pullback in the payout ratio or a price drop that bumps the yield above 3%. If you're willing to accept some volatility for long-term growth in a recovering industry, with the comfort of very low debt, SIA is worth your research. So, is SIA Engineering a good buy before this ex-dividend date? For the long-term Singapore dividend investor with a balanced approach, the answer is, it depends on your risk appetite. It's a respectable pick for those comfortable with cyclical swings in industry recovery, but not one to bet the HDB on. Let's quickly review what we've learned today. Longevity and yield are just the starting points. Sustainable dividends require steady coverage, conservative payouts, and strong cash flow. A wide moat and favorable industry tailwinds can tilt the odds in your favor. If you found this analysis helpful and want even more investing wisdom, please like, share, and subscribe. And for those who want to be truly ahead, our premium members get exclusive early access to all our videos, sometimes a whole week before anyone else. That means you receive my urgent market insights and deep dive reports straight to your inbox, ahead of the pack. It's only $1 a month, less than a kopi from the Kopitiam. Consider it your daily dose of financial fuel for smarter decisions. Ready to join the inner circle and receive that early edge? Just hit the premium member link in the description below.